The stock and bond markets do an eloquent dance with the economic indicators. The markets change and the economic indicators change, but people tend to make decisions based on the latest and most impactful news bursts. The one point to always remember is that the stock and bond markets of the world are discounting mechanisms. What I mean by this is that they will move in price base on the expectation of what economic indicators are coming out. They do not move as a result of them. Sure, sometimes we experience the often quoted buy, sell the rumor, and then conversely, buy, sell the news. But normally, unless an economic indicator comes that is wildly different than the expectation, the indicator tends to confirm the market action prior to the indicator being released. Well, this is what we are dealing with now. Fed Chairman Jerome Powell spoke at the Fed's annual symposium in Jackson Hole, Wyoming on Friday, and while he did not say anything new, he confirmed what the market already knew, which is that the Fed is likely to lower rates when it meets again in September. Powell was not specific on whether such a rate cut would be 25 basis points or 50, as the Fed remains data dependent, and this week's Bureau of Labor Statistics jobs report might figure into this. Either way, the market started lowering rates back in April, so Powell's speech had nothing new to offer beyond what the market already seems to know. Jobs revisions give Biden a black eye with the massive 818,000 number last week, but the Fed gets cover to cut. In hindsight, it is all so perfectly clear. I discussed Powell cutting pre-election, but how given there was no cover to do so, as the administration, financial stations, and pundit class all continually harp on the envy of the world economy. Something had to provide that shade, and the release of the jobs revisions that saw $818,000, a third of what Biden claimed to produce. We all knew this was chronicled monthly with the non-farm payrolls and their divergence with the household reality check surveys. The response to the question, "Are you currently working?" was either no or "I have to work 2 jobs." Oh, someone working 2 jobs when another is not working. To avoid rambling down the litany of issues, the news provided Powell the cover to act politically and not necessarily look as if he is acting politically. This current list of existing criteria is significantly different than what has been the case in the past few rate-cutting cycles. If you are to remember, it has almost always either been a black swan type of event or an impending recession coming on. This time, besides it almost purely being a function of the need to normalize rates, since they were taken straight up from 0 to 5.5%, there are several firsts going on. Here they are, in no order of most important. A string of firsts for the easing cycle to come. It will be a cut of firsts. Cutting without any impact on record levels of home unaffordability, with housing prices and rents at all-time highs. Cutting while food prices at home and away from home are at record highs. Cutting with stocks at all-time highs, though that is explained by the massive federal spending, Fed monetizing Treasury's debt, and the again increasing money supply. Cutting, as I have noted frequently this year as well as earlier, while money supply is already expanding. I am quite concerned that inflation will explode. The Fed quite possibly should be further hiking rates, as inflation in key areas is still hitting record highs. Candidate Harris suggests freezing prices, inflation to rampage. In short, gird your lifestyle for more inflation ahead. If Harris is elected, she will give first-time buyers $25,000, and that will drive all house prices higher by at least $25,000. Rates will surge. It is a trade-off. Lower rates now with all-time high prices, or higher rates later with dropping prices as the economy possibly sees recession. Yet if we look at what investor activity is doing, it is clear that as inflation ebbs, albeit temporarily, the equity markets seem to like it. What is important to remember is that the speech by Powell last Friday was at a time when interest rates appear tight. To explain tight, one must look at the current interest rate short term as compared to the current measured rate of inflation. As can be seen in Fundstrat's table here, we are at a tight level currently. This has historically been very positive for equity markets going forward. The question as to why strong this time is that when interest rates are lowered during a non-inflationary period, the markets tend to act quite positively. Yet, if the rates are lowered in a perceived action where the Fed is chasing a declining recessionary economy to get it back on its feet, it tends to precede negative stock market action. Recall this study from Ari Wald at Oppenheimer. Remember, inverted means that short-term interest rates are higher than long-term interest rates, and this has always preceded a recession. This is not the case currently, since I like to measure the possibility of these statistical validity by seeing how both individual investors and institutional investors are voting with their wallets. I find the current situation a backdrop that could be the action prior to a market moving quite strongly to the upside. As can be seen here, institutions have pulled quite a lot from the stock markets in the last 20 weeks, and the next chart shows individual investor doing the same. To show how institutions have been acting, I find it important to say, okay, if they are pulling money out of stocks, where are they putting these funds? Here it can be seen that they didn't just pull them out of stocks, they actually pulled more than has been pulled since November of 2021, just before the Fed started spiking interest rates higher. And they are opting for putting the money in bonds. Bonds tend to appreciate in value, besides paying their interest when interest rates are falling. So I am assuming that the institutions have been pulling from stocks to avoid a possible recessionary economic move and transferred to bonds to hide out, earn income, and maybe get a bit of appreciation as well. The important quote from Powell last week was undeniably, "The time has come for policy to adjust." The market took this to mean that almost for sure the Fed will be cutting rates in September. The question then remains, if this is being done to preempt a slowdown, which could be bad for equities, or is the Fed lowering rates slowly to simply reverse part of the too high, too fast that they did in the previous cycle? The answer to this riddle is yet to be written. Yet according to Jeffrey Sott of Sott Research from his weekly commentary this Monday, the rally has lifted the S&P 500, SPX, 5,634.61, back towards its all-time high of approximately 5,666, and leaves the SPX very close to that all-time high. My hunch is the SPX will break out above that all-time high, triggering a short-term trading target of 5,835. From there, the upside will depend on the economic and news backdrops, which I expect to remain positive. Indeed, unless something totally blindsides us, I just do not see what derails the equity markets from here. So go down to your local bar and have a few and watch the stock market show that is certain to be interesting. I am expecting an upside breakout and new all-time highs. However, do not be surprised if the breakout does not happen on the first attempt. In fact, over the past 60 years of my stock market observations, there have been numerous times where it has taken at least 3 attempts before such an upside breakout occurs. I don't know if we see a straight move up or a labored back and forth, but something tells me that as Iran and Israel heat up and our own contentious election hit full conflict mode, markets surely won't go in a straight line in either direction. Today's big cap technology earnings should give some color on what is happening in the market leading sector, but how strong it can continue to will be the question to be answered going forward. For now, I think that proper balance while sticking with what is working should be the best course of action. As things change, we will too. But for now, we are sticking to our knitting, yet keeping our eyes peeled for black swans should they develop. Please don't hesitate to call with any questions you may have.